Hello everybody. So today I want to briefly discuss 11 stocks that are way too cheap in my spreadsheet. These stocks have very high revenue growth and very low multiple. That's why I have selected them. By revenue growth, I look at next 12 months revenue growth, and when it comes to the multiple, I look at my own metric, which is a spin on the peg ratio. It's enterprise value over gross profit over revenue growth. Why do I use gross profit, for example? Because I consider that often whatever is after gross profit, whatever comes after gross profit is actually an investment and not a cost. For example, oftentimes I consider marketing an investment, right? Because if you invest in marketing, you have recurring sales, you gain a customer for the lifetime value of the customer. Same R&D. R&D, in my view, is most often an investment. It is not an actual cost of doing business. It's an investment in the future. And I think gross profit is kind of this better metric, right, than traditional earnings, say, that you would use in the Peter Lynch ratio of price to earnings to growth ratio. So that's the only change in this spin. And then I use revenue growth, and gross profit growth being of course very much equal. All of these companies are more or less optimized for gross profit, by the way, which is why I've selected them. So let's go ahead and discuss. And I added the rule of 40. So the rule of 40, of course, is whenever you add adjusted EBITDA, so that's a proxy for cash flow. EBITDA is a proxy for cash flow. Whenever you add the EBITDA margin and the revenue growth, you want to have more than 40. And that's a VC rule to highlight stocks that may provide much greater returns than other stocks, essentially. So anyways, let's go ahead and talk about it. So first of all, Sezzle. I talked about Sezzle one time before on this channel when it was much more expensive. And it dropped quite a bit. It's $70 now. Not too long ago, this stock was $170. And after the drop, the stock is very cheap. Enterprise value over gross profit over revenue growth is 0.15. As a reminder, anything under 0.3, I consider quite cheap in this spreadsheet. Rule of 40 is 111. Sezzle, what do? They are a buy now, pay later play. They're a smaller buy now, pay later company. Higher growth than all of the other players like Afterpay or like Affirm. So it's higher growth, it's a smaller player, and in my view, this stock, the numbers look pretty good. Then let's talk about the real brokerage, ticker symbol REAX. So this stock has been able to grow. They've been able to grow their platform every year for like the past 5 years, and we grow very, very fast. And that is despite having the most awful real estate market. The way REAX grows is they go after the top performing agent of your local mom and pop broker. So, your Keller Williams, etc. REAX will try to attract these top performing agents and let these top performing agents, leave their old firms, join REAX, and REAX, the commission system is made in such a way that it's particularly attractive to high-performing agents, to agents that do a bunch of sales each year, because in their fee system, they have a threshold, and I can't remember what it is, but if you hit a certain amount of fees on that threshold, then the broker stops taking any money. So they will make money on you for, say, the first 20 sales, and then they stop making any money. And because of that, they've been able to grow very fast because they are taking away real estate agents from brokers who move on their own on the REAX app. And of course, it's an app, so it's much cheaper to operate. Anyways, rule of 40 is a 53. Enterprise value over gross profit over revenue is 0.1. And that stock is quite interesting. Of course, the EBITDA margin and gross margin are going to be pretty low because we are in the real estate sector. But the flip side to that is the enterprise value over sales is ridiculously cheap. It's it's 1/10 of what it is for Sezzle, for example, because you're paying only a fraction of our revenue for that stock. It's only an $800 million stock, and it makes $1,800 million in revenue trailing 12 months. So anyways, moving on. HIMS. HIMS needs no introduction on this channel. I cannot possibly understand why HIMS is trading at 37. I just don't get it. I can't get it. They've been executing so well. They're going international. Everything's doing so well. They keep executing. They keep doing well. Every other day we have bullish news on HIMS, and the stock is in the gutters. It's getting more and more dislocated from GLP-1. I guess the market's still associated into GLP-1, but I have no idea why it's sold off so much. Maybe it's a small cap. I don't know. This market has been so weird. I consider HIMS to be a steal at an enterprise value over gross profit over renewal for 0.11. That never really increased much. I mean, I guess at some point we're at like a 0.08, so we're a little better, but that never really increased much. The stock is still heavily undervalued, and HIMS, has the potential, in my view, to be kind of a big tech company or a mini big tech company in the health sector. That's kind of my take on HIMS. They are going after everything, and HIMS, as a reminder, it's a digital doctor and a digital pharmacy without insurance, with AI. So it's AI-enabled prescription and AI-enabled drugs, and they're able to do that. They're able to move very, very fast because they do not accept insurance. If they accepted insurance, they would move much slower. And the case in point, of course, of this is LifeMD. LifeMD is a stock that got literally battered. It went up to $15, and now it is $3. It's back to the level it was roughly a year ago. Actually, a little lower than a year ago. Despite this stock, the stock has performed okay. LifeMD I've always called baby HIMS, right? It's not as good as HIMS. It doesn't grow as fast as HIMS, but it is much cheaper than HIMS. And by much cheaper, I mean, 0.027 versus 0.11. It's about 4 times cheaper than HIMS. It's very rare that you see enterprise value over gross profit or revenue growth in this low of a level. So this stock is way too cheap. There's no other way around it. They're still growing at 24% revenue growth, which is pretty good. But the reason why they grow slower, in my view, is because they try to accept insurance. Like GLP-1s, they have a GLP-1 offering. They try to get people to qualify for GLP-1 via their insurance. And so they have all of these issues where they prescribe a GLP-1, and then 5 weeks later, they find out, the insurance doesn't want to cover it, and so the customer just ends up canceling the GLP-1 order, and they also get to keep the GLP-1. In a nutshell, that's what happens. They haven't been able to grow as fast because they use insurance. That's my take. Also, in the numbers, we should see LifeMD grow a little faster going forward because they sold WorkSimpli. They had a software business which they sold, and so that's going to give a clear picture to Wall Street. I think this stock is way too cheap. I also think it's not as good as HIMS. It doesn't execute as well as HIMS. Like, we've been waiting for a menopause offering for LifeMD for quite a while. As soon as HIMS said they would launch menopause, they literally launched it like within weeks of announcing they would launch it. LifeMD, we've known they would launch this for almost 6 months now. They still haven't launched it after an acquisition. So they don't move nearly as fast as HIMS. And I would argue the reason why they don't move nearly as fast is because they have to try to integrate with insurance companies, and they have to try to figure out how they can help you qualify for your insurance benefits. And that takes forever. That moves at the pace of trad health versus neo health in the case of HIMS. So anyways, moving on. Nebius. Okay, Nebius, and then I'll talk about Nvidia. Let's begin with Nebius. Nebius, I cannot possibly understand how it is so cheap. This stock is going to do anywhere between a 10x and a 20x revenue over the next 12 months. They signed 2 enormous deals, one with Microsoft for $19.4 billion, one with Facebook for $3 billion, I believe, or something like that. They have Microsoft and Nebius, Microsoft and Facebook, Meta, who contracted with Nebius for data center, for cloud GPUs, and the stock is in the gutters. I mean, it was 135. That was, in my view, that was the good reaction. That was the initial reaction, was the proper one. And now it's trading at 87. Not to mention, Nebius has, to me, a very interesting 28% stake in ClickHouse, which is very, very interesting. I was reading about ClickHouse the other day. ClickHouse is actually used by Tesla. Tesla uses ClickHouse in its AI endeavors, and it's in its machine learning endeavors. It's to tell you how ClickHouse is reasonably a competitor to Snowflake or Databricks at some point, and they own a enormous stake in it. And so that is not represented in the valuation of Nebius. They also own AV Ride. AV Ride, I believe, could strike deals with a lot of OEM, or auto manufacturers, old world auto manufacturers. When Tesla rolls out full self-driving everywhere, the other manufacturers, if they want to sell car, they're going to have some sort of self-driving offering. And I think AV Ride could have a possibility of licensing their service. They own AV Ride fully. Nebius is also a mini big tech company who's not trading at all like a mini big tech at $20 billion. I see enormous upside in Nebius. Moving on to Nvidia. Nvidia, the most valuable, the most expensive company in the world, but also the cheapest of the Mag 7. And you can't make this up. This is all of the Mag 7. All of the numbers have been outdated. In my spreadsheet, Nvidia is the cheapest of the Mag 7. Second cheapest is Amazon. Second cheapest is Meta, Third cheapest is Amazon. Nvidia is cheaper than Meta, cheaper than Amazon on a growth-adjusted business at 0.43. Rule of 40 is the highest out of all of them. It's 128. And also note how I am also only giving Nvidia a growth number of 69%, saying they'll only grow revenue by 69%, when we know that they could grow much more than that, because at GTC, Jensen said 500 billion over the next 5 quarters. So we are a quarter down. So it could be 400 billion over the next 12 months. Could be. And so in that case, the revenue growth number might actually be more than 100%. So even though Nvidia is the most expensive company in the world, even though it's a huge company, it's a huge size, it's also the cheapest because of how fast it is growing. The initial reaction when the stock was $200 was the correct reaction. I do not understand this sell-off, especially after their last earnings call, which was more bullish than ever, when Jensen essentially said, oh, we're all sold out. Everything is sold out. So anyways, moving on to OSCR. I want to talk briefly about OSCR. OSCR is dirt cheap. Enterprise value over gross profit over revenue growth is 0.026. Rule of 40 is a little low, but I will give them the benefit of the doubt because insurance companies kind of operate a little differently. They operate a little bit differently. They focus on the medical loss ratio, so using EBITDA may not be actually the best. Actually, I should use the medical loss ratio, which is in the lower range for an insurance company. Anyways, the point I want to say about OSCR is I think revenue growth is going to be meaningfully higher than 25% going forward, because if you look at some of the pricing that they are showing for 2026 in the 18 or 19 states where they operate, those premiums on Marketplace are way, way up. They have been rising the premiums a lot. And the forward guidance for OSCR does not include any possibility of an ACA subsidy. So you're looking at a company who's going to increase the premiums greatly. You're looking at a company who is dirt cheap, and you're looking at a company who has very good guidance going forward. The only downside, of course, is that it's an insurance company. And as you know, on this channel, I'm not a big fan of insurance companies. So to me, OSCR is kind of a swing trade. To me, OSCR is a double and then I'm out, because over the long run, I don't want to be investing in insurance companies, because insurance companies have too much regulation. The regulator can just change overnight, and these companies are too influenced by politics, especially healthcare. But over the short run, I find OSCR to be way too cheap. Now, let's move on to another company that I find way too cheap, is CorMedix. CorMedix enterprise value is 0.034. For CorMedix, a company that just did an acquisition. They are an antifungal / anti-infection company. Their main product is a dialysis product that prevents infection when people go to dialysis. I've covered CorMedix multiple times on this channel. The chief advantage of CorMedix is that their products, antibacterial products, anti-infection products, they save money to Medicare. And if you save money to Medicare, I believe you're less at a risk of a cut. You're less at a risk of, say, the CMS cutting out your reimbursement for your product, or cutting out your product codes. And so even though it is on the back end of healthcare, I believe CorMedix is relatively safe relatively innovative. It is an innovative stock. Of course, what makes CorMedix special, and if you have access to my spreadsheet, I have 20 different healthcare companies. They're all very interesting. They all do cool stuff. But what makes CorMedix super special is how cheap it is. CorMedix has an equally cool product to a lot of innovative health tech cos. It's got an equally fun product. I like the product, but I love how cheap it is. Depending on what you look at, for example, if you were to compare CorMedix to say Transmedix is a loved stock out there. CorMedix is about 10 times cheaper. It's about 10 times cheaper, and it has less customer concentration. It has a more diversified product. It's about 10 times cheaper, right? So anyways, and it's printing cash. 40 EBITDA margin is 41%. Gross margin is 96%. Predicting the next 12 months revenue growth is 120%. So you have a rule of 40 of 161. So I love CorMedix very much. I think CorMedix is too cheap. And let me conclude with 3 stocks. So this is the only quote-unquote software stock or SaaS stock that I'm going to cover. And I used to cover those much more on the channel, but they all got expensive. This one is not expensive. It's Zeta. Zeta Global. Zeta's latest product, Athena, kind of reminds me of a mini Palantir for marketing. It's very interesting, their next product. And I find this stock quite interesting. They have a top-down approach. There's a lot of similarities of Zeta and Palantir, actually. The company is growing fast, nearly 30% next 12-month revenue growth. Their EBITDA margin profitable at 21%, Rule of 40 is 49%. And they keep updating their guidance and guiding up and guiding up and guiding up. And it's a very interesting marketing platform. I could see it compete with a CRM like a Salesforce at some point. I could see them have a much bigger footprint. And I see this company as way too cheap. Enterprise value is only $4 billion. Market cap, $4.5 billion roughly. Let's call it $4.5 billion. It's way too cheap. So it's interesting. If you're interested in that one, you feel free to look at my full analysis. Then another stock that I like, that I've covered multiple times before on the channel, is ON Holdings. So these are running shoes. So On Holding is a Swiss company, very interesting ownership structure, kind of designed to be operated by the founders for 30 years or something. Very expensive product, high margins, gross margin is 62%, forward revenue growth is 31%. Rule of 40 is achieved at a 45. Enterprise value over gross profit over revenue growth is a 0.22, so this one is dirt cheap. It rebounded a little bit, though. So, yeah, at 35, that was a buying opportunity. Unfortunately, it rebounded a little bit. I think On Holdings and Hoka, but you can't buy Hoka. That's the problem. It's embedded within a bigger company or other brands. But On Holdings is a pure play. I think On Holdings is, along with Orca, I think they're taking a lot of market share from Nike. And that's why you see Nike not performing very well the past 5 years, because these new neo brands are really taking a lot of market share. And in my view, On being the pure play, if you want to be in the sector, if you want to be in the apparel sector, I find On much more interesting than Nike or Lululemon. So that's just my take on this. We'll see how this goes. So the last one is, of course, MercadoLibre. I used to cover MercadoLibre in the early days of the channel. It's as steady as it gets. This stock is cozy. It just moves pretty slowly. Low volatility stock, stable stock, and it's growing very fast, 36%. Gross margin is 50%. EBITDA margin is 15%. We have a rule of 40. Of course, MercadoLibre, if you don't know what it is the Amazon of Latin America. They are the leader in Brazil. They're doing well in Mexico. They're doing well in Argentina. They are the Amazon of Latin America. They are the winner there. And in addition to Amazon, they also have a fintech division and a lending division. So it's kind of the super app and the e-commerce side of Latin America. They're doing very well, growing very fast, and they are very, very loved. And so I like this stock in a portfolio. I think MercadoLibre is very interesting. Note that with $2,000 a share, you're going to have less options activity on MercadoLibre, which makes it more stable. I find this stock much more stable. On days when we've had so much volatility in the market, MercadoLibre, we kind of act as a beacon for the portfolio. It's much more stable. And I think this has to do with the expensive stock price. So anyways, these were the 11 stocks that I kind of like right now. I find them way too cheap considering how high growth they are. This was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching and have a wonderful, wonderful day.